morning, ladies and gentlemen. Welcome to Business Today Television. The markets remain range-bound, remain weak the moment there is a decent uptick intraday, and there is pain. There is pain across the board as far as mid-caps and small-caps are concerned, but bulls trying very hard to retain 25,800, 25,850 with them. But to understand the psychology of the market, to get a peek into what institutional players are thinking, to understand the way forward, we are bringing you the top voices in Dalal Street who understand this market in a manner which is far more sensible than many other analysts. Joining us on the show is Mr. Devan Choksi, Managing Director at Dr. Choksey Finserv Private Limited. Mr. Choksey is a very well-known value investor on Dalal Street, and not only him but his family across generations have held stakes for the very long term in dozens, if not hundreds of stocks where great value has been unlocked. Namaste Devan bhai. Terrible times for the market, all sorts of good macro news coming in, GDP at a 6-quarter high, breaching 8%, rate cuts galore, retail investors pouring in 29,000 crore rupees each month into equities, yet we are in pain. What is happening?
Yeah, Shell, good morning. Well, it is not a very surprising phenomena though, I think I would say. On one side, the macro parameters remaining absolutely robust, and that is possibly acting as an engine power to this entire journey that we are experiencing as passengers. In my viewpoint, I think the corporate sector is also equally doing phenomenally well. We haven't seen the top line growth and the margin growth simultaneously happening in the business, which we are experiencing even in the corporate sector today. In my viewpoint, I think the market is passing through a pain, largely because of, I think, its own past. In the past, till the time I think the flooding of IPOs started coming into the market ended up buying some of the valuations at an absolutely crazy level. Today also, I think that crazy valuation is being seen in some of the counters, even after the price corrections in many of them. When a company's business growth is seen growing between 15 to 20% at the best on a sustainable basis for next 3 to 5 years, you end up paying a price of 70, 80, 90 times the price earning ratio, which suggests that the company's business is almost growing 1.5 years. End up making double, as against I think the business growing at 15-20%, which is 4.5, 5 years kind of a growth. So that is a mismatch that this market created in the past 1 year, 2 years, and that's where probably I think the markets are having this pain. Maybe small cap, mid caps are getting badly affected. Today the situation is that I think there are less takers of those companies in the portfolio because of the higher valuation. So I think I would think that time correction will be the only remedy in which I think situation can get little normalized.
Devan, by time correction, one understands, 12 months, 15 months have already passed on the Nifty, nobody has made a single paisa. But it is the price erosion, especially in the last 15-20 days in the mid-cap, small-cap space, that is really hurting the way retail is viewing the market. Many stocks like Bajaj Technologies, many stocks like Indigo is a large cap and is event related, but many stocks have corrected between 30 and 45% in the last fortnight alone.
Yes, I think, and that is because they are putting it at a premium valuation. They have no margin of error or margin of safety, as we want to call it, as left in their price. So obvious it is that I think some of the names which you are mentioning, they're quoting today also at I think higher than 50 times price earning ratio. Where is the scope for any error in this particular price earning ratio? Moment I think you made a mistake, I think the market will punish you. Today, the situation is that I think in every rise, the investor wants to get rid of mid cap and small cap, which is bought at a higher valuation. So that's the reality. And if that is continuing for next 1.5, 2 years, that means you are going to see more pains than otherwise in mid cap and small cap. Whereas I think the large caps, though they have not performed, but they have not dented the portfolios. And that is more important. They have protected the capital. They have not performed, but they have protected the capital. So to a greater extent, I think you will be seeing the results coming out of the large caps in some next 12, 18 months, vis-a-vis I think the mid cap and small caps.
Okay, so for those who are investing in the mid cap and the small cap space via funds, they are better off because they can leave it to the intelligence of the fund manager to navigate this volatility, pick up new stocks, and maybe book losses or book profit in the ones that are not moving. But what about individual investors in the mid cap and the small cap space? 10, 12, 15 stocks in the portfolio, the bleed is 30-35%. What should they do? Clean it out?
Consult the right person, I think, to approach the portfolio restructuring and possibly, I think, start the corrective course. Unfortunately, I think in every rally, the individual investor is getting stuck because I think he is employing his own mind and expertise on a subject which is not his. Time and again, the wisdom has said one thing, that a subject which can be handled better by somebody, I think you should not be handling into it, especially when it is related to money and health. Today, I think that situation has once again come when we look into the portfolios of individual investors, we find some of the wrong decisions and grossly wrong decisions taken by them just because they bought tips. And that's where the problem is. However, it is still not late. I would think that the investors should approach quality advisors and in turn, I think, get the portfolio addressed for growth. If at all, I think the mistakes have happened, I think correct those mistakes and make the portfolio work for growth. That is the simplest way to handle the subject, at least at this point of time.
Okay, fair point. At what level on the index for the small cap or the mid cap would you suggest that smart investors with a horizon of 3 to 5 years come into the sector via a good small cap, mid cap fund which has a 15-16 year record to show of riding volatility? How would you time your entry, if at all, in this space?
So I think when you are invested in a fund, I think the timing of that fund, I think, is basically done by the investment is done by the fund manager. So I think your job is to basically, I think, put money through SIP into that fund, as long as you are confident about the fund manager's strategy playing well. So that is the best thing that you could do. But probably, I think, if I go a little further and analyze the situation, today mid cap and small cap companies, when you look into Nifty 500, which constitute almost 95% of the market cap, and beyond Nifty 500, where balance 5% of the market cap is there between Nifty 500 and Nifty 750. I think that's where probably the problem is. The companies which are beyond Nifty 500 and companies which are beyond Nifty 200, they are today quoting at a valuation of somewhere around 40-50 times price earning ratio average. And that's a pain. Suppose if as a fund manager also who has entered into those companies, I think, at higher valuations, or even individual investors who entered into those companies at higher valuations, they have no choice but to, I think, either cut down their losses and invest money smartly into some of the compounders, or else, I think, allow the time correction to get over and let the portfolio not perform for a few years. Either of the choice, I think, will have to be exercised by the investor, I believe.
Okay, these are very, very painful decisions to make, but they have to be made if you are looking for your financial health to be cured. Devan bhai, now let's look at the large cap space. Some of your favorite stocks are doing very well. L&T, Bharti Airtel, M&M, Reliance in particular, SBI of course. These are stocks that you have repeatedly advised on to be on the long side. Is this rally, if at all, going to be limited to this space only because of valuations?
So they are going to be the compounders. They may not
Okay.
be giving you very high return, but they will be giving consistent return of around 20% on, I think, in every successive year for next 5 to 10 years. Some of these companies, largely because of the fact that I think these companies have become big. They're investing also into the newer businesses in a very systematic manner, and they're making sure that every 4 years, 5 years, I think the balance sheet size gets double, which is fundamentally very important. Some of these names which you have mentioned, I think they are typically having a character of doubling the size of the balance sheet every 4 years, 5 years time, and they are accordingly investing into the businesses, which we like. And that's where probably I think you are also guaranteed with the profit performance in forthcoming period as well. Yes, I think they too pass through challenges, but at the same time they're large companies, and as we have said always before,
Hmm.
the big is getting bigger.
Hmm.
And if your eye is on getting bigger, then I think only follow those big guys, because I think they are basically making the size bigger. Mid cap and small caps, I think will run in a good times. I think the price performance point of view I'm talking about, they will give you fantastic price performance in good times. But in another than good times, I think a normal time, mid cap, small caps, I think would result into capital erosion. So that
Hmm.
is where we feel that I think you should be allowing your capital to get compounded, and that
Hmm.
too with the bigger companies which are basically becoming bigger from here onwards.
Okay. Devan bhai, at this stage, what are your own ultra HNI clients doing? Are they averaging lower, or are they just on the sidelines, or maybe they are buying gold, silver?
No, we are seeing the entry of new money into the portfolios. That is a very good sign, because we believe that I think most of the investors who are matured enough, they are bringing new money at this point of time because of the corrective phase of the market. The way in which we position ourselves, I think we say that we are investing into the businesses which are having the visibility of next 5 years or so, or maybe next 10 years also in some cases. And that is where I think we are attracting those investors to invest in those companies. Our approach remains simple, that as long as I think the underlying business is growing in a measured manner, I think you should be investing money into the market. You may be going wrong in timing for a while, but ultimately growth will catch up. At the same time, we are asking investors to always put money through a systematic investment approach basis, even in direct equity, like how you do in mutual fund SIPs. In direct equity also, you can buy the staggered manner into direct equity, which probably helps, I think, many of these investors. And that's where I think we see the higher amount of AUM building year after year in our PMS as well.
Okay, fair point. And at this point of time, any new buys that the research team has come up with?
So we continue to like some of the potential upsiders in form of I think companies which are in, say for example, housing finance, companies which are in engineering R&D business, companies which are in providing the solutions to the manufacturing sector in form of a B2B product line of activities. So we are selectively buying even real estate, ultra luxury real estate segment. We feel that I think it's a good opportunity, because ultimately the larger amount of capital is being paid for buying some of the discretionary assets like real estate. So selectively we are buying. We are also very confident about the auto ancillary segment, because overall the OEMs are doing well, and as a
Hmm.
result of which ancillary segment is also providing good opportunity. So yes, I think it's a mixed bag in which we are putting our investment. But yes, we are very mindful about the companies sustaining the profit and profitability.
Could you name some of these companies?
So, with a disclaimer, yes, that I think we may have investment interest, our research coverage, and our personal holding as well with that disclosure, and with a request that I think these companies need not be, I think, seen as a tip, but I think should be seen as an idea which one needs research. So we find in real estate, I think companies like Lotus Developers, I think looking really interesting from investment point of view from long term.
Which developer?
Lotus Developers.
Lotus. Okay.
Then I think the companies in engineering R&D space, we like Tata Technologies, where they are providing, I think, the ultimately all the ADAS-based solutions to the new generation of vehicles. So that is where this company looks, I think, probably more interesting. In finance segment, Bajaj Finance, Bajaj Finserv, Bajaj Housing Finance, they remain really good choice because I think they have the ability to unfold the business grow the business and unfold the growth in a significantly larger manner. You mentioned Reliance. We like it more because I think they've incubated some of the very strong businesses which are now getting monetized. Next year will be the time when Geo platform is getting monetized. Maybe sooner thereafter, retail platform should get monetized. So yes, I think some of these companies, they are basically giving you an opportunity from long-term perspective. They may or may not give you immediate 3 months, 6 months return, but I think if you are holding them for a period, the possibility of I think you earn your 15-20% CAGR return in those companies is distinctly high.
Okay. So, from what I could make out, Lotus Developers, the triple twins of the Bajaj Group, which is Bajaj Finance, Bajaj Finserv, and Bajaj Housing Finance, and Reliance, and a few auto ancillary stocks is what Devan Bhai is advising clients. But remember, please be very, very careful at this point of time to put them in your portfolio. You need to take an advice of an independent financial advisor as well. As always, Devan Bhai, thank you very much. Deep pleasure listening to your very thoughtful, very considerate and very calm opinion on the pain ahead. And let's hope that the Almighty gives us strength to bear that pain over the next 1 year or so. Thank you for your time, sir.
Thank you, Shail.
That, ladies and gentlemen, was Devan Choksi, Managing Director at DR Finserv Private Limited. Thank you for watching. Please continue to be with Business Today Television. We try to get you the best voices in the market who can navigate this volatility, this pain, this incessant selling, and this issue that we are facing in the market. Thank you very much.